tax is a compulsory payment made by individuals and businesses to the government. This revenue directly funds public infrastructure, the defense budget, and the state welfare system. In the UK, the central authority responsible for collecting this money is His Majesty's Revenue and Customs, or HMRC. Every year they collect over £600 billion. Income tax, national insurance, VAT, and capital gains tax together account for roughly 2/3 of all government tax revenue. Mastering these specific mechanisms is the requirement for accurately modeling UK financial liability. To begin, the system is split into two structural categories: direct and indirect. A direct tax is paid straight to HMRC by the person or business that owes it, calculated on their personal earnings or asset gains. An indirect tax is built into the price of goods and services. You pay it as a consumer, but the business collects it and passes it on to HMRC on your behalf. All of these taxes operate on a specific temporal rule. The UK tax year does not follow the standard calendar year. It runs from the 6th of April to the 5th of April the following year. This offset timeframe and the structural divide between direct and indirect levies provide the data points needed to calculate an individual's actual financial liability. Income tax is a direct tax. It's charged on your employed earnings, profits from self-employment, and streams like rental income. The UK uses a progressive tax system. You do not pay a flat rate on all your income. Instead, different portions of your income are taxed at different rates. Higher rates only apply strictly to the money earned above specific thresholds. Think of it like driving through a series of toll booths. The first stretch of the road is completely free. As you drive further, you pass into new zones where the toll gets progressively higher. This chart shows the progressive bands. For the 2024/25 tax year, the first £12,570 you earn is taxed at 0%. This is your personal allowance. Above that, the progressive bands stack up. The basic rate at 20%, the higher rate at 40%, and the additional rate at 45%. Take a taxpayer like Emma, who earns a gross salary of £28,000. To calculate her tax, we first deduct the £12,570 personal allowance from her £28,000 gross salary. This isolates her taxable remainder at £15,430. We apply the 20% basic rate strictly to that remainder, giving Emma an annual income tax liability of £3,086. For most employees, this amount is automatically deducted by their employer through the pay-as-you-earn or PAYE system. Self-employed individuals calculate and pay this themselves through a self-assessment return. Income tax functions as a mechanism of marginal shielding. The personal allowance ensures a base livelihood is protected before the state takes a cut. The second direct tax on earnings is national insurance contributions, or NICs. This revenue is specifically hypothecated to fund the NHS and the state pension. You can picture it as a mandatory shared vault. Both employers and employees drop funds into it, ensuring the state's welfare safety net remains solvent. Looking at this breakdown, the 2024-25 employee Class 1 NIC rates start at exactly the same threshold as income tax. You pay 8% on earnings between £12,570 and £50,270, and 2% on earnings above that. Using Emma's £28,000 salary again, we can see exactly how much of her income is exposed to this second tax. Her earnings clear the free allowance, leaving £15,430 within the 8% band. Multiplying that by 8% yields a liability of £1,234.40. When we subtract both the income tax and the NICs from Emma's gross salary, her net take-home pay is £23,679.60. While politically treated as separate entities, income tax and NICs function mechanically as a combined direct progressive tax on the working population. Value-added tax, or VAT, shifts the burden from earning to spending. It is an indirect tax applied to the purchase of most goods and services. Imagine every shop has a silent cashier standing right behind the real one. You never pay HMRC directly. Instead, the business extracts the tax at the point of sale and passes it to HMRC. The standard rate of VAT is 20%. However, essentials like most supermarket food and children's clothing are zero-rated. Calculating 20% of a retail sticker price yields an incorrect result. This receipt illustrates why. The sticker price already includes the tax. meaning it represents 120% of the item's base value. To extract the VAT amount from a VAT inclusive price, you divide by 6. Dividing the £1,200 total by 6 gives us the exact VAT amount of £200, leaving a base price of £1,000. Because it is built into consumption, VAT represents an unavoidable secondary layer of taxation. The state captures further revenue on money Emma has already paid income tax and NICs on. The final core tax is capital gains tax, or CGT. This direct tax is levied solely on the profit made from selling a chargeable asset, not the total sale value. There is a distinction between an unrealized and a realized gain. An asset going up in value while you hold it triggers nothing. The tax event only occurs when the asset is liquidated. A vintage watch bought for £5,000 can sit in a vault appreciating in value for years without triggering a tax bill. But the moment it is sold for £17,000, the gain is realized. In this scenario, HMRC ignores the original £5,000 cost. Capital gains tax is only applied to the £12,000 profit generated by the sale. Looking at this block representing the gain, we factor in the annual exempt amount. For 2024/25, this acts as a £3,000 tax-free shield, carving out the bottom section of your profits at 0%. If the seller is a basic rate taxpayer, their capital gains tax rate on most assets is 10%. We apply this rate strictly to the remaining £9,000 taxable gain. 10% of £9,000 leaves a final capital gains liability of £900. Note that selling your main home usually falls under private residence relief, making it exempt from this calculation. Capital gains tax acts as the final net on wealth generation outside of traditional labor. It captures value when static assets are turned into usable liquidity. This split screen compares how these taxes interact with different income levels. Direct taxes scale progressively as earnings rise, but VAT functions differently. Because it is a flat consumption tax, VAT is mathematically regressive. A 20% charge on goods consumes a higher percentage of a lower earner's total disposable income compared to someone with high wealth. A taxpayer's true financial burden is the combined force of these pillars: PAY wage deductions, hidden consumption taxes, and levies on asset disposal. Understanding this structure allows for tax efficiency, the practice of minimizing this burden by utilizing government-provided statutory shields. The most common tool is the Individual Savings Account, or ISA. It allows you to shield up to £20,000 a year, creating a barrier against both income tax on interest and capital gains tax on investment growth. Navigating the mechanics, thresholds, and interactions of these four taxes provides the data necessary for professional financial modeling and individual wealth management.